Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Really excited for today's show. We've got a guy with a lot of experience in the apartment investing space and very happy to introduce you guys to Ken Gee. So Ken, welcome to the show today.
Thank you so much for having me. I'm looking forward to it.
Yeah, me too. Me too. I mean, I've been looking at your bio and your history, and I think I'm probably going to learn quite a bit today. So
I will too.
yeah, let's start with this. Why don't you just tell us a little bit about yourself and, kind of how you got into the apartment investing industry and where you've gone from there?
Sure. So I grew up in Toledo, Ohio. Probably nobody's ever heard of that unless you watch MASH back in the day. I grew up there, got my undergrad from University of Toledo. Then I moved to Cleveland. And so I became a commercial lender. So I spent 5 years as a commercial lender. And then while I was pursuing my master's degree at Case Western Reserve, I thought, you know what? I was so tired of hearing my clients say, well, let me talk to my CPA. Let me talk to my CPA. I'm like, well, wait a minute. I don't want to be that guy, right?
Yeah.
So I switched gears and got my master's in accountancy and I became a CPA. Spent 7 years at Deloitte, one of the big firms, doing all kinds of merger and acquisition, all the fun stuff. I did a lot of fun stuff there, but it was there that really everything changed for me because my kids were very, very young. We're talking like 25 years ago. We're talking a long time ago. And my kids, my daughter was an infant and she had just come home. I used to do her middle of night feeding. And that was really cool because everybody in the house is asleep and it's just her and you. And if, for the dads out there, there's nothing better than a dad-daughter bond, right? It was that whole experience that made me realize, I don't know, I started to get frustrated. I'm like, wait a minute, this is 3 a.m. and this is the best I can do for my daughter? Like, really? I got frustrated. And the reason I did is because, I mean, look, I went to school, got good grades, got a good job. I'm like, man, I am set. And then I realized, wait a minute, problem. My family was going to grow up and never really have me around. And that really made me just really upset. So I said, you know what, I got to change this because I don't know what you know about CPAs, but they work really hard.
They do, especially in like April and October.
Yes, sir. You got it. You know something about that. So then I said, all right, I got to change this. So I had done a little bit in real estate, but not much. So I went and I figured out, okay, how am I going to do this? I'm at Deloitte. I'm working like a dog. I don't have much time now. So I started, like a lot of people, how do I figure this out? How do I start? And back then they didn't have your podcast. They didn't have masterminds. None of that stuff existed. So I got to go to really, really exciting apartment association meetings and network with the people who spoke. And that was kind of how I figured out the business. But what happened is I bought 3 small properties. I bought a 28 unit, a 22 unit, and a 24, and then a 22, right? And really didn't have any money, but, did a lot of leverage back then. Sold them 3 years later and made $500,000. And I was like, oh, wait a minute. Are you kidding me?
Let's go back to those. I mean, just a regular guy, accountant at Deloitte. How were you able to purchase those 3?
Great question. So my first one, it was the first one's always the hardest. I watched so many people do this now since then. And I remember during that whole process having what I thought was a golf ball in my throat every day, that level of stress. I'd never felt that stress before in my life and then never felt it since. But I pushed through. And what I did was the first building I paid $575,000 for. Remember, this is almost 30 years ago. And I borrowed my half of the down payment and I got my in-laws. Like, nobody's going to trust you because you don't know what you're doing yet. But my in-laws did at the time. They said, look, if you put in half the down payment, we'll put in half the down payment. I borrowed it on my home equity line. And that's how we bought the property.
Nice.
As it turned out, the seller was a super nice guy, very large owner now in the Cleveland area. Super nice guy, right? I couldn't have had a better seller, no question about it. But then I said, wow, I kind of like this. This is good. Then I went and bought another one. I just canvassed the street. Who wants their apartment buildings up and down the street? So I just kept pounding people till I got somebody to acquiesce and sell me his building. Did that differently. I didn't do it with much money because back then we could get financing for all the improvements. You could really leverage these things up back then. And then the third building, I fell into it, right? The development corp had bought it. Basically, it was condemned. They put tons of money into this place and really made it beautiful. And they wanted to sell it to somebody in the neighborhood who would take care of it. And we were one of the 5 groups selected because we had good relationships with them. So we were able to buy that property. That was the last one that we had bought. The interesting thing about this was because I answered this question for a lot of people, they're always trying to figure out, man, how do why did you not start with a single family or a duplex or something like that? And I remember sitting at my desk in my cubicle at Deloitte thinking, man, I can't go show apartments. I can't fix stuff. I don't even, first of all, I don't even know how. And secondly, there's no way I had time. So
Mhm.
in my mind, I had to buy something big enough that I could run like a real business and hire somebody to be on site for part-time and help
Yeah.
me with some of that stuff. And that's how I ended up in the apartment business was that decision. It was obviously, it turned out to be a very important one.
Yeah, yeah. And you actually answered the question that I was just going to ask. So, yeah. So three properties, you owned them for a couple of years, you sold them, made a
Yeah.
500,000. I assume you paid back your in-laws.
Oh, of
Uh,
course. Yeah. Yeah.
yeah.
That was profit. The 500,000 was profit.
Yeah, good numbers there. I mean, really good number, especially 25 years ago. I mean, 500,000
Yeah.
25 years ago is probably a low seven-figure sum today.
Yeah. No, you're right about that. And you know, what happened to me was I realized, wait a minute, I just did on the side.
Mhm.
I made more money on the side than I did the whole time I'd been up to Deloitte. If I added every year up, I hadn't
Mhm.
made that much money. And I thought, man, this is something I got to pursue.
Mhm.
And you know, since then we've done 19 deals and you know,
Wow.
everything's been completely different. So
Yeah. And I had a similar thing. It wasn't with my salary, it was with my investments. I bought, a couple single family homes and, 5, 6 years after buying them, I looked at my 401k, and I was putting money in every single month into that 401k versus what the properties were worth and what the equity was and what the cash flow was. It was not a comparison. It's just like, it was so lopsided that I'm just like, I shouldn't put
yeah.
anything in the stock market right now. I want to go all in on real estate. And I did. And I mean, I think I'm much better for it now too. So, but yeah, so 19 total. Let's get into, next steps after those three and how that
Yeah.
progression.
Yeah. So what happened now, even though I made $500,000,
Yep.
you know, I wanted to grow and I knew that I needed somebody with a little more liquidity than I had
Yep.
and more experience and a bigger balance sheet. So I was able to develop a relationship with a super nice guy. He was an attorney, did a lot of evictions in Cleveland.
Yep.
And he's still my partner to this day in one deal that we have together.
Nice.
But he said, you know what, Ken, you know, we developed a relationship. We had similar goals and we had a lot of respect for one another. He didn't want to operate, but he knew what to do. And he knew he had got a lot of good relationships. So we partnered together. He was kind enough. The money in the deal was lopsided, right? He put more than I did, but I did all the work,
Yeah.
right? I always tell people early on, man, you've got to find that relationship. If that's what you need, you do whatever you got to do to get your first few deals. And
Oh, yeah.
so we did a lot of deals together, made
Mhm.
a lot of money. And that was a problem that I had to solve. That was how I was able to grow.
Yeah.
Now I don't have that, right? That
Yeah.
things are a lot different now.
I wholeheartedly agree. Do whatever you have to do to get into your first deal. I remember our first deal, looking back, I overpaid for the property, but what we did to make that deal work is we offered a preferred return and a 90-10 split to our investors.
Hmm?
And my logic behind it was, getting this first deal is going to be a launching pad to the
Yeah.
next deal, and
Yeah.
so on that first deal, I did not make a lot of money and I didn't care because of what it meant for me
Yeah.
going forward. So yeah, I agree. Whole, slightly different way of explaining it, but yeah, do whatever
You
it
solved
takes.
the problem. You
Yeah,
solved the problem. You needed to get your first deal
yeah,
because once you
exactly.
do that deal, what happens? Now you're real.
Now you're in. Yeah, it's
You're
like you
real.
move from the
You're in the game.
sidelines onto the field, and you're now a
That's
player.
right.
Yeah. So yeah, so you partnered with him, you got some deals going. Go from there.
Yeah, about 10 years in,
Mhm.
we did a couple syndications together. I was familiar from my days at Deloitte. I was very familiar with the private equity model because I
Yep.
did a lot of private equity work. And so I said, hey, we should do this syndication thing. We did it, a couple small deals, and he had since retired.
Yep.
And again, we still have one syndication deal together that we've owned now for 8 years. But now, a number of years ago, we're in Florida now. 15 years ago, we said we started in Cleveland. We did really well in Cleveland. The first 10 years, we didn't really raise any outside money, but it's really hard to make money in Cleveland. It's
Mhm.
not, nothing's wrong with Cleveland except demand does not exceed supply,
Yeah.
right? And that's hard. I mean,
Mhm.
you're going against the tape when you do that.
Yeah.
So I thought 15 years ago, I said, man, what if we actually did this in a market where people want to live,
Mhm.
like they really want to live? Well, they
Yeah.
really want to live in Florida.
Hmm.
right? For a lot of reasons. And guess what? Myself included. I'm like, hey,
Hmm.
I can create my own world and reason to be where I want to be. So 15 years ago, we started the process. I started the process of breaking into that market is not easy because there's a lot of people with a whole lot of money and it's everybody's deeply entrenched. Well, 15 years later, we're one of those people now. We
Hmm.
are the people that are deeply entrenched, but we started out syndicating. So in order to get our deal, we had to pay up. So a few years in, I said, man, I'm just tired of paying up. We did well, but what if we actually did what private equity firms do, right? Most people, syndicators go find the deal, then raise the money. Let's
Hmm.
flip that around. So let's raise the money first. And that's what we do now. We're on fund number 4.
Hmm.
And once we have the money raised, we go to the brokers and guess what? They
Yeah.
really like you then because
Hmm.
that whole certainty of close, everything changes when you have the money raised. It
Yeah.
just does. And we weren't wrong. I mean, it absolutely has helped us become very, very well integrated into the market. And even today, I mean, we're getting deals that 10 years ago, no way they would have ever
Yeah.
awarded to us.
Somebody asked me this question. I want to get your thoughts on it. Do you think you could have started by raising a fund first, or did you think you had to go through that syndication phase first to do it?
You got to have a track record because a fund, by definition, is a blind pool fund.
Yeah.
So you're raising the money first, and the investors have to trust you, whether you're a syndicator or a fund manager, doesn't matter. But the trust has to be even higher in a fund
Yeah.
because we make the decisions about what we buy, but they have 19 deals to look at. They're on our website. We
Yep.
hired a company called Veravest to come
Yep.
in and vet our entire track record.
Hmm.
So now they're like, okay, well, this is for real. I can see
Yeah.
what these people have done over and over and over and over. If you try to do that too early, it's hard to raise the money. It's hard to raise the money anyway,
Yeah.
but it's even harder when they don't have a track record to look at. You don't have experience on your side. So most people, and us included, we started out syndicating, and most should, because then investors have the opportunity to look at the deal with you.
Yeah.
Because early on, in some cases, some syndicators, some of the limited partners have probably have more experience than they do,
Hmm.
right? And there's
Yeah.
nothing wrong with that, right? What again, you got to do whatever you got to do.
Hmm.
And if you're early on in your business, it's very few people are going to trust you to run a blind pool fund. They just won't because they don't know what you're going to do.
Awesome. That was almost textbook my answer. I just love the validation. I think that was
Yeah.
kind of like asking that question to make myself feel good. So, but yeah, I found the same thing. I've talked with a couple people that wanted to start a fund like that and basically ran into the same obstacles. It's like,
Yeah.
okay. And I mean, in my future, we're planning on starting a fund, but we got to get to the point to where we have enough people that are going to say, Brian, I trust you no matter what you do.
Yeah.
Here's my money. And I think
That's
when we
right.
hit that point with enough people, that's where that fund makes sense. So
Yeah. Agreed.
yeah.
100%. Yep.
Awesome. Awesome. So you have the fund now. I mean, you're on fund number 4. How do you structure the funds? How long are the funds in place? Can you go a little deeper into that one?
Yeah, yeah. So typically, I'll give you what we're doing with Fund 4.
Okay.
It's a straight 80-20 split.
Hmm.
So on a capital event, which means a sale or refinance, you get all your money back and we split 80-20.
Hmm.
It's literally that simple. On
Okay.
the cash flow distributions that go out quarterly, those are the smaller distributions. We split those 80-20.
Okay.
That's it. And then our
Easy.
fee structure is extremely low. We're at 1% acquisition, 1% disposition, and 1% asset management fee. That's it.
Okay. Yeah. I love simple. Now, did you say you have to return investor capital before hitting that 80-20, or is it 80-20 on all profits?
It depends on the event. So if it's a capital event, you get all your money back first,
Okay. Okay.
right?
Got
So I
it. Got
shouldn't
it.
be able to refinance. If I go and refinance or I go and sell, you should get all your money back first
Yeah, exactly.
before we split profits. It's
Okay.
the smaller quarterly. Remember, our fees are really low. I mean, 1% is pretty low fee. I
It is.
think you would agree because I'm not here for the fees. That's what I always tell our investors. Guys, I just need the fees to keep the lights on, right? I mean, you can't go backwards in business.
Yeah.
So that just is enough to keep the lights on. I'm really here for the long term, the promote, the carry interest, the profit share. That's
Yeah.
why we're here. Because what happens when we do that? We align our interest perfectly with the investors. And
Yeah.
that's what you want to do.
I am of the opinion, and I wish I could convince more people. I wish I had a magic wand, but I think the straight split does align things better. I was actually talking to a group of CPAs yesterday, and I made that same statement. I'm like that a lot of people think the preferred return is good for the investors, but quite honestly, it does not align interests, and I do like the straight split a lot better, but I think a lot of investors are conditioned to that pref and they want to see that pref. So
Yeah, but let me tell you, do you mind if I share with you what happens and why
oh,
we
please do.
departed from it?
Yeah.
Right? Because I was resistant to depart from it because
Mhm.
I felt like the investor should get the first. But here's what happens.
Mhm.
So let's assume that I have a deal. I love the deal, but it only throws off 4 or 5% in year one. But it's there's just so much upside. Like
Yeah.
I don't want to ignore this deal. But I have a pref in place. So now what happens? So here's what happens. If you have a six pref, the investor expects a distribution of 6%. You can tell them all you want that it's cumulative and it'll accrue and don't
Mhm.
worry, you'll get it eventually as long as there's enough money. Right out of the gate, if you don't distribute what they're expecting, you've kind of failed in their mind. And you don't want to start off a relationship with any investor and
Yeah.
with any kind of negative feeling. So
Exactly.
that's one scenario that could play out, right? You could buy the deal, not meet their expectations, and they're just gonna get frustrated from day one. You don't want that. Alternative two is, okay, I don't want to frustrate the investor, so I'll go into my pocket
Mhm.
and pay the difference
Yeah.
and get it back later. Well, that's not sustainable. I mean,
Yeah.
that's ridiculous,
Yeah.
right? Scenario two fails. So the
Mhm.
third scenario is you don't do the deal.
Mhm.
So now you just missed out on an incredible deal that everybody would have made a lot of money on, but you
Mhm.
couldn't do it because of this. I call it handcuff. You handcuffed yourself
Yeah.
with this problem, this preferred return.
Mhm.
The other thing that happens is, and I've watched this play out, especially in the '08 crisis, if there is a preferred return, and let's say the property is kind of struggling, right? So you have somebody working like a dog trying to keep your investment in good condition, right? And keep it moving forward, but they're not getting a penny out of it.
Yeah.
They're basically working for free.
Yeah.
They should, right? They should take care of the investor and they're doing the right thing.
Mhm.
But eventually what happens is they're going to have to decide how to split their time between that deal that might be struggling and the next deal where they could earn more money.
Yeah.
Human nature, I'm not saying everybody would do this, but human nature, it's going to start affecting their decision on how much time they spend on your deal because
Yeah.
you have somebody working basically what could be for free. Now you have a misalignment, right? Now the only guy that can save you is the guy who doesn't get anything out of. Now he's just doing it out, and he should, right? I'm not saying he
Yeah.
shouldn't
So,
do
I
it.
mean, it's a sense of duty at that time. It's the
Yes,
responsibility to the investors, and you're right,
yeah,
they should. But I
but it
like how
gets
you put
harder.
that. Yeah.
It gets harder, and the deal might be suffering for nothing to do with
Mhm.
what the manager did, the syndicator did. I mean, who knows, right? It could be some issue
Could be
that
market related. I mean,
could be
market risk is
completely.
real. Yeah.
That's right.
So
Yeah, it is. It
mhm.
is. So now you have this poor guy or gal working for nothing.
Yeah.
And so I used to not understand the story until you really just think it through and you're like, man, you're right. You want this guy to get something. How many days out of a 40-hour work week are you going to go to work if you know you're not going to get paid?
Exactly.
Eventually, you're going to say, man, what am I doing here?
Yeah. And that's something that I've seen, firsthand. And I think let's look back to 2019 to 2022 when the rate before the rate hike cycle
Yeah.
started.
Yeah.
There were a lot of syndications that started as 3 to 5 year holds that were selling at 12, 13, 14 months. I think that pref structure that really incentivized the syndicators to sell. Whether
Yeah.
or not the investors
Exactly.
wanted to hold or cash out, the syndicators were sitting in this position where, man, if we sell right now, we make $1 million versus hold for 5 years and hope the market stays strong. A lot of people were
Yep.
choosing to cash out because
Yep.
that's when a syndicator gets paid, is when they
That's
cash
right.
out. So yeah, I've seen that, and we've had discussions inside partnerships, where those exact arguments come into play where, hey, we're not making any money on this property, but we are on that property, and when it comes down to time constraints and I only have this many hours in a week, what you said is exactly right. It is human nature, and sometimes you have to have those incentives aligned. So yeah,
Right.
I'm a fan of that straight split. We are still doing preferred returns because I've had enough investors tell me that, they're only investing with prefs. So
Yeah.
against my better wishes,
Yeah,
but
I will tell you, we didn't lose too many people,
mhm,
right? But I don't. We've been doing it for a long time, so maybe we were fortunate. What's really important in this business is sponsor maintains discipline, on
Yeah.
the deals that they do, no matter whether there's a pref or not.
Yeah,
You got to
absolutely.
make sure you don't get FOMO. Whatever you do not get FOMO.
Yeah, absolutely. Yeah,
Mhm.
I had a really good friend, former partner. We just sold the last property that we're partnered on together. And, he's also, an LP in a lot of deals. But he told me last week, just to your point, he's like, I'm perfectly fine accepting market risk. He's like, what I don't want to accept is the sponsor risk. What he meant by that is the people that aren't doing what they're supposed to be doing. So yeah, you gotta find
Yeah,
somebody who's
no,
going
you're
to
right.
manage the property and do what they say they're going to do. And yeah, I love it.
I always tell people I want them to follow 4 rules. If they're going to invest passively, because look, the reality of it is, it's kind of like the Wild West, figuring out should they invest with you, should they invest with me, should they invest with Sally, Joe, right? They don't really know. But if you follow 4 rules, you got to make sure that the sponsor has experience,
Mhm.
right? For obvious reasons, but the least of which is, can they figure out how to navigate things like COVID, things like high inflation, things
Mhm.
like interest rates that went up 500
Interest
basis
rates.
points in 10
Yeah.
minutes, right? Those are experience things.
Hmm.
Second thing is you want them to have a track record. Seems obvious again, but here's what's important.
Yeah.
You got to know that that sponsor has gone full cycle, because anybody
Mhm.
can buy deals, but not everybody can sell them and make money. So
Mhm.
track record, you want them to be transparent. That's extreme. That is the biggest reason we did Verivest,
Mhm.
because we wanted someone to come and vet our 27 years of track record.
Yeah.
So that when you look at our deals, you're like, somebody looked under the hood here. And
Yeah.
then
Look
finally, you
legit.
got to make sure they put the investors first.
Yeah.
If you
Absolutely.
follow those 4 rules, now every deal that goes south, usually 1 or 2 of those rules are broken. I've been able to forensically look at a lot of failures that people have been involved with, and almost always 1 or 2 of those rules are broken.
Yeah, I agree wholeheartedly. I'll be honest, what you said was really hard for me to hear when I was a younger investor, when I
Yeah.
was first time in it. And for those listening, it is hard to hear, people like me and Ken tell you that you have to have a track record when you're trying to break into the market, but there are ways to do that. Anyway, back
But what did I do early on? What did I do? Remember, I
partnered with
rented someone's
somebody.
balance sheet.
Yeah, yeah,
But what else did he have? He had an enormous amount of experience.
exactly.
So go find the experience. You can solve that problem. You just have to focus on it and solve it.
Mhm. It is 100% solvable, and the answer is partnering.
Yep.
And the honest truth is I had to partner with people up front that had more experience too, because the other reality is banks aren't going to give you money if you don't have experience. They might love the property, but they have to love you too, or they're not going to give you millions of dollars to go buy a property. So it's not just a nice to have, it's an absolute must. You have to have
Yep.
somebody with experience willing to partner with you. So
Absolutely. And you can find it.
yeah.
Yeah. You
So
just have to
yeah,
look for it.
there's lots of people willing to do that. So going back to where you're at right now, I think you said 19 properties. You're mostly in Florida right now, or are you exclusively in Florida now?
Right now, we happen to be exclusively in Florida, but we're open to anywhere in the Southeast.
Hmm.
But right now, deal flow is just now so high
Hmm.
because there are so many people who didn't manage their debt properly and so on and so forth. There are so many deals coming out now.
Hmm.
It's hard to digest them.
Okay. Is there still a big gap in Florida between what buyers can pay and what sellers want?
Of course, we call it the expectation gap. It's always going to be there.
Hmm.
But right now, there are some sellers, and it's unfortunate,
Yeah.
probably due to the lack of experience and track record, that made bad decisions about how they handled their debt and things like that, that
Hmm.
they have to sell.
Yeah.
And that doesn't mean we're going to try to take advantage of people, but
True.
there are some pretty, really nice opportunities out there right now.
Mhm. Yeah, and I mean, what I'm seeing in Salt Lake is you get an occasional new property. Now, there's several cities in Florida that have more population than the entire state of Utah. So, just kind of put that into perspective.
Right.
I'm getting brokers that are sending me the same deal that I saw and underwrote a year ago. So
Yeah.
there's a lot of deals sitting that sellers are willing to sell on, but there's not a lot of people willing to pay a price that'll make the seller sign a contract. But I mean, looks like something similar, but that you've definitely got movement down in Florida.
Yeah, you have to, because what's happening is over the last couple of years, well, since rates went up, right? I think last December, everybody thought there's going to be massive rate cuts, remember?
Hmm.
And everybody's like, this is it, man. This is my ticket out of this deal. The variable rate debt, my rate cap's expiring. This is my way out.
Hmm.
And then it didn't happen. and
Yeah.
it didn't happen, and it still didn't happen, and it still hasn't happened.
Yeah.
And these people are literally running out of runway is what's happening to them.
Mhm.
So they have to sell. They don't have a choice, right? Because they can't, their interest rate, the property cannot afford 4% to 8.5. It just can't afford that.
No.
And so they have to sell.
Yeah.
And they're
And
running out of runway. They are out of runway now.
there are the people that have to. And when you're looking at, everybody made a similar mistake. Everybody saw rates were going to go up, but I don't think anybody forecasted they were going to go up as high as they did.
No,
I
you
don't
can't
think
protect against that. You
anybody,
can't.
yeah,
It's not even possible. Yeah.
yeah. I mean, it hasn't been since like 79. I mean, it's been, let's see, I was 2 years old the last time rates went up this fast, that far, that fast, and
Right.
so I'm actually extremely fortunate that we had a bunch of fixed rate bridge loans instead of the variable rates. Otherwise, I might have had a couple properties go south.
Yeah.
But that's something I've been
Yeah.
very fortunate about. But
Well,
yeah,
that's part of what '08 taught me, was because what happened in '08, '09, the credit markets froze up.
yeah,
Nobody could refinance anything. We didn't lose any money during that time, by the way, and I'm thrilled for that.
mhm,
But what the people that did fail, they just had a debt problem. So ever since then, it has caused me to be always longer term in my debt, always try to get fixed rates.
mhm,
If I think I'm gonna hold a property 5 years, I'll put 7-year debt on it. And people are like, what are you doing? You should only put 5-year debt. How do I know I'm going to be able to sell it in 5 years, right?
yeah,
I don't know that.
mhm,
So I've always erred on the side of being conservative. So if I have to hold it a little bit longer, that's a whole lot better than the conversation that people are having right now with their
yeah.
investors.
Well, now, when you set up your loans, are you doing mostly agency loans or do
Yeah.
you? Okay.
Yeah. Yep. Yep.
Okay. Now, with the agency loans, just curious. I mean, for people listening, there's a couple different prepayment options, but are you getting kind of a more friendly prepayment option, or are you just doing with the regular, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 on a 10-year loan?
Yeah, so most of the agencies are defeasance or yield maintenance. So, but the smaller the SBL loans,
Mhm.
you can get the step down. And I guess you could probably buy a step down on the longer stuff, but we typically have not done that. If you're looking at a small loan, Freddie SBL, I love Freddie SBL loans.
Yeah.
They're very inexpensive to put in place, and
Yep.
you can get that step down
Mhm.
pretty inexpensively. Then you know what your prepay is going to be, right? In my case, we'll just I just put 7-year debt last year in a couple of deals, and hey, I'm okay with that.
Yeah.
That is far better than any other situation. And if I have to hold it too long,
Mhm.
I'm okay with that.
Yeah. I like 7-year debt. Right now, I'm doing mostly 5-year debt. We
Okay.
actually just bought a place with 7, but when I say just, this was last October. But right
Okay.
now, I think five years kind of like my sweet spot where it gives us a long runway, not quite 7, but it also gives us a little bit of flexibility
Mhm.
because we have a
Yep.
lower prepayment penalty if rates do come down far enough. But
That's right. Yeah. No, you're right about that.
and once again, I hate to say this, I would love to put 20-year debt on everything and, hold
Yeah,
for 20 years. But most investors, and then unfortunately, you kind of got to do, if you're syndicating, you got to do what your investors.
that's right.
Anyway, a couple last questions for you. First
Okay.
one is, what's next for you?
Well, we're just gonna continue to rinse and repeat, right? Our goal for Fund 4 is 20 million,
Mm,
and we're more than halfway there, so we'll get there, I'm sure. And we're just trying to buy the highest quality assets we can using relatively low leverage, and just going to continue to raise money because look, I watched what happened when people bought in 2011. I mean, they just made insane amounts of money, right? We're not quite like that, but we
mhm.
have a similar situation. We have a credit market problem, just like they had back then.
Oh, yeah.
And there's zero chance I'm missing this opportunity. We're just going full speed ahead because there's some really high quality assets. We just closed on a brand new deal just out of lease up with upside, and we are just under a 6 cap.
Yeah.
Like that should not be happening in Florida.
Mhm. Yeah, I wholeheartedly agree on that one. I was in the single family space before the crash, and I started buying I bought some after. You bought one pre-crash and a couple more post-crash, and I think it feels kind of like 2010 right now in the
It
apartment
does.
investing space.
Yeah.
So
Yeah. I'm with you. I agree.
yeah, and hopefully we have that bull run that we had from 2012 to 22 coming in our future too. All right, next question. If you were to give advice to somebody contemplating getting into the apartment investing market, what would that advice be?
It's interesting. Our entire business is structured around that entry point.
Yeah.
because people know there's so much money to be made. They just can't figure out how they should participate. So
Yeah.
what I want them to do, and what we try to help people do, is just, first of all, you got to take a real hard look at your life,
Mhm.
right? Because do you have time to do this as a business? Is this something you really want to do? Or are you a physician or some, or a professional? Are you have a small business right now that makes more sense for you to focus on that and invest passively? So some people who have the time, they want to do their own deals. We have an entire investor education
Mhm.
side of our business that takes them, all the way through, and we teach them exactly what we have done for 27 years and how we do everything. Or maybe you are that physician, you are that business owner who
Mhm.
wants to make the money and invest passively, then you go down the fund side of our business. So the thing that people need to do is be honest with themselves about their life, what's
Yeah.
going on with their family, with their time, with their
Mhm.
business, with whatever it is, and be realistic. So
Yeah.
many times I see people, they always think the grass is greener on the other side. So they literally stop what they're doing and jump over. Well, it takes a minute to ramp up a real estate business. It doesn't happen in 2 months. It takes a long time.
Mhm.
And so a lot of people find themselves leaving. I counsel people all the time on this.
Yeah.
I had a Harvard trained physician who wanted to stop being a physician. He taught at Harvard Med School so that he could get into buying 15, 20 unit apartment buildings. I said, you cannot do that. Not on my watch, my friend. You need to
Mhm.
keep doing what it is you love and invest passively in real estate. You will still get what you're trying to get out of it. So, as you can tell, I'm pretty passionate about helping people down this road, because so many times people make the wrong decisions. And what they also don't know is there's no reason why you can't try both. Right? I was at Deloitte and bought my first apartment building. So you don't have to go 0 to 100 in real estate. You
Mhm.
can do it very slowly at your own pace, totally fine. Just don't screw up your day job. And that's what I did when I was at
Yeah.
Deloitte.
Yeah.
Right.
And I think most people just kind of, adding on, most people are transitioning from one employment into multifamily.
Yeah.
And for most people, there's a period of time where you're essentially working two jobs. I look back at, my time in my transition, my last 3 years in the Marines, I was essentially working two full-time jobs,
Mm-hmm.
and it paid off. It paid off
Yep.
big time
Yep.
because, I was able to leave the Marines without having, a drop in income, a drop in lifestyle.
Right.
But, I love what you said, Ken, be honest with yourself. If you don't have
Absolutely.
the ability to put that kind of time into it, go passive. If you do
Yeah.
have that ability, put time in, do both, especially if you have the funds to do it, do both. So
Absolutely. Agree.
awesome.
Yeah. Yeah. Just get in the game.
Yep.
That is important, right? Is that you get in the game.
Awesome. Awesome. Now, last question. How can
Mhm.
listeners learn more about you?
Yeah, go to kripartners.com
Okay.
and you're going to see our business split right in half,
Yep.
investor education and our funds as well. So kripartners.com,
Mhm.
or just reach out to me, kgee@kripartners.com. Either way,
Awesome.
love to help you through that process and get you headed in the right direction.
All right. And we'll have a link to that website in the show notes for anybody who wants it. Just, tap your phone, swipe to the bottom, and tap the link, and that magical internet thing will just whisk you away. Don't know how it does it, but it does. But
Does, yes.
all right. Well, hey, Ken, thank you for coming on the show. You definitely added a ton of value.
Well, thank you so much for having me. I've enjoyed it.